All right, this is assignment 13 for the trans math class. And it's going to deal with life insurance, different types of life insurance and stuff. I hope none of your parents are life insurance salesmen and they're watching this video because I'll probably screw up a bunch of stuff in it and not actually completely know what I'm talking about, and they'll probably think that I'm an idiot. But most of it's just basic ideas to give you basic knowledge of different types of life insurance and things that you can use to try to figure out, what life insurance to get, if you need any, so on, so on, so on. First thing, so what we're going to do, there's tables. We're going to talk about those tables, be able to use those tables to compute the annual premium for term life insurance. That's one type of life insurance, is term life. And then apply tables to data to compute annual premiums for 3 other types of life insurance. Life insurance is just financial protection for a family in case the main source of income dies. So my wife has 4 or 5 life insurance plans on me. That way if I die, then she's going to get some money, and that'll help her to support the family if I'm gone. That's what life insurance is. Term life insurance. Term life insurance is the cheapest life insurance. The bad thing with term life is you get the life insurance for a specific term, such as 5 years, or to a specific age, maybe 40, 45, or whatever. And you buy that life insurance, and knock on wood that nothing like this happens, but if you die within that term, then it's great, because then you get the face value of the term policy. But if it doesn't, then it's just for that certain term, and either you have to renew it for another term, or you just let it go and it's gone. So that's term life insurance. So if you get term life, and if you start getting some kind of insurance and you're 20 years old, and it's a term of 10 years, then that means when you get to be 30 years old, that policy runs out and it's no longer any good. So maybe, and it'd probably be real cheap, because most people don't die from 20 to 30. So they're going to give you this life insurance, and it might be, $7, $8, $10 a month or something. And then when you get to here and you want to renew that term policy, that price is going to go up. And the older you get to be Mr. Ebersol's age, which we know is ancient. And I try to renew my term policies, well, the price goes way up. And all these policies are based off of, some of them you'll have to maybe get a physical or something, depending on what you do, whether you use tobacco, whether you smoke. I'm sure they'll stick vaping in there now. What kind of job you have, so on and so on. All of these things go into the cost of some life insurance policy. If you're a lion tamer, then your life insurance policy is going to probably cost more than somebody who is works at McDonald's. The beneficiary is the person who receives the money from a life insurance policy if the insured person dies. So for like me, my beneficiary is my wife. A lot of times they'll have secondary beneficiaries on there also, in case something were to happen to me and my wife at the same time or something, and that would be like my kids or something. for me. So a beneficiary is just a person who gets the money if something happens to that person who is insured. Again, we go back up here to this term life insurance. The cost, the premium, which is the amount that you pay per year of the life insurance, depends on your physical, whether you smoke, you drink, all this other stuff, and it depends on your age, and how long you're going to have the term out for, and how many units of life insurance you buy. Each unit is usually considered $1,000. So if you just want one unit, then you're getting $1,000 worth of coverage. If you want 2 units, $2,000. 3 units, $3,000. So on, so on, so on. Usually, you won't get, just 1 unit or 2 units or 3 units. Usually, a life insurance policy will be for $20,000 or $50,000 or $1 million, whatever it is. It'll be something like that. Something that's whoever the beneficiary is gonna actually be able to help them to cover expenses once you're gone. All right, so the formula that you're going to use for this stuff is annual premium. Remember, this means for a year. So your yearly premium is the number of units that you purchased times the premium per $1,000. And this number is going to come from a chart that I'm going to show you here in a minute. So we're just going to take the number of units that we want. Maybe we want 40 units. Then we take that 40 times whatever this number is from the chart. And that's, it's just like with banks and stuff. When we talked about banks, if you go into some insurance place, they probably got a little chart on their wall that has set up so that they know, all right, if they want 30 units, then it's going to cost this much per unit, so on, depending on your age and all the other things. This is the chart. So on this chart, if we look at this chart, you got your age. The first one here is 18 to 30. Notice that the prices for 18 to 30 are lower than the other prices. So, and that's because they don't, just like with any other insurance, the probability that you're going to die isn't as likely as people who are down here in the higher range. And you'll also notice that males are higher priced than females because males have a higher probability of dying or a lower life expectancy than females. If we get down here, you notice it's 321 for a male that's 18 to 30. Then you get down here to 60, and all of a sudden it's up to 17, 19. And I've got a couple of term life policies for myself, and at the age I'm at, it's now, when I was a little bit younger, my wife didn't mind paying them. Now every time that they come in and we have to renew it and that premium goes up, she's not too happy about it because we're paying in a bunch of money. And the life insurance companies like that because they're using that money and probably making money off of it. So as you get higher and higher, and these numbers are probably low now compared to what they probably are as of right now. You notice when you get way up here, females are like $5 cheaper per unit than males. That's quite a bit. This policy is for a 5-year term plan, and notice that they have set a minimum, the minimum that you can get, so you can't get just like 1 unit. You got to get at least $50,000 worth, which would be 50 units. And we're going to use that chart. This chart's going to be used on the first part of the assignment. Some other kinds of life insurance. Whole life insurance, also known as permanent life insurance, offers financial protection for your entire life. So if you get a whole life plan, you're saying, all right, I'm going to pay this premium for, sometimes it'll be a set amount of time. I'm going to pay this premium for the next 20 years. Or I'm going to pay this premium till I'm 65. Or I'm going to pay this premium for 10 years, whatever it is. But then that policy stays with you. Unlike a term plan, once the term's over with, you got to start all over again. So whole life is permanent. You keep it for the entire time, as long as you're paying the premiums. When you have a whole life, it has a cash value, and that's the amount of money you will receive if you cancel the whole life insurance. It's not going to be everything that you paid to that company. It'll have some kind of cash value at that certain time if you cancel it out. You can also take a loan on these insurance, on these whole life insurance policies. So you could take out a loan on it, and it'd be just like taking a loan out from the bank, except for the fact that it's actually your money. So you're sort of loaning money to yourself and then paying the insurance company back with interest on that loan. So with the whole life insurance, it's also, and this I could be wrong here, but it's also like with some of these policies, it's like a savings account also. So you're putting that money in there, and that's where this cash value comes from. You're putting that money in there, and it has a cash value once you get so far along in it. If you just started up a whole life policy, and then you go in there a month later and say, hey, I want to take a loan out using my whole life insurance policy, well, you're probably not going to get very much, because if you've only paid in a little bit, they're not going to just give you out some great big huge sum of money. All right, so it's probably it's based on what you have put into it so far. Limited payment policy is a whole life insurance policy that is paid up to a specific number of years. So this is just a different kind of whole life insurance. You pay for a specific number of years or until you reach a certain age. But then, so let's say you will set it up so that you pay till you're 50. Then once you're 50, you are done paying, but that insurance policy stays as part of your coverage. I know with my parents, who are probably a lot older than your parents, they had policies like this a lot more back then. And so even though my mom and dad hadn't paid on an insurance policy for 20 years, we had to find out that, hey, they had this insurance policy that they didn't even remember that they had paid off, because they paid up to a certain age or a specific number of years to get it. Universal life insurance is a combination of life insurance policy and a savings account. So it covers, this is another type of whole life insurance. It covers the insured for his or her lifetime, and any amount the insured pays over the minimum premium goes into an investment account. So you can put in extra money here, is what they're saying, and you can get it put into an investment account, and it will earn interest for you. So it's like a savings account. So those are different types of life insurance. Again, I'm not very good at explaining them because I don't know a whole lot about them. I know what I've studied, what I have and stuff, but I'm not greatly into it. And this is just basic knowledge here to give you a little bit of knowledge about how to look at these life insurance plans. A Formula to use on this second part, annual premium is going to equal the number of units purchased times, it's the same thing, times the premium per $1,000. And again, we're going to use a chart. And we have this chart, annual premiums per 1,000. This is chart 11.3. It goes by your age here. And then if you're paying up to your 65, so on, whole life for males, and this last part out here, oh, I can move that, apparently not. So this chart shows age, didn't mean to do that. And then it's got a policy that if you're paying up to the age of 65, what your premiums would be. You got a whole life policy, male, female, and then a universal life, male or female, what you pay as your monthly premium. So we're going to use that chart for some of the stuff. And you'll notice down here on this chart that they're not going to, if you're going to pay up to age 65, they're not going to give you, if you start at 55, they're not going to give you a policy probably. I mean, I'm sure you could come up with an amount and pay them, you know, $100 a month or whatever, and they would, or $100 per unit, and they would accept that and pay you once you start at 55. But they're not, so you can't take out a life insurance policy for $1 million when you turn 85, because you know you might not be around a whole lot longer, and expect that they're going to, you know, go along with that, because the insurance company has to make money also. Down here at the bottom, chart 11.4 is optional payment plans. All of this is if you pay your premium in one lump sum for the entire year. Down here shows you that what they'll do if you pay it semi-annually, so twice a year, then each time you pay 50.5%, so you actually pay 0.5% more than just half. And that takes, or what that does is it gives them a little money for dealing with the paperwork and everything, and you not paying in one lump sum. If you do it quarterly, notice it's 25.5, so again, that's another 0.5% added on each quarter that you're paying into them. And then monthly, it's 8.5% it's 8.5% times your annual premium, and that would be your monthly pay, and how much you pay per month. We're going to use these, again, use these two charts for some of the problems. I'm going to try to do a couple of these problems for you. This isn't one of them. I'm going to skip over this one. This is a problem from the last assignment. But I wanted to say, notice that, like, if you're own your own business or whatever, you got to pay 100% of your insurance, health premium, your dental plan and stuff. I didn't really mention that. So if you own your own business, then you got to pay the whole 100%, not where your employer pays, you know, 75%, you pay 25%. So that's one thing that you got to keep in mind when you're doing stuff like starting up your own business and everything. Alexandra Davis is 30 years old. She wants to purchase a $75,000 5-year term life insurance policy. The premium per $1,000 is 2.77. That comes off the chart, the first chart that I showed you. What's her annual premium? All you're going to do here, using that chart, and you're not really using the chart because they've already told you the number from the chart. That's where that came from. All you're going to do is use the formula. You got $75,000 here. That means we're going to take that number, we're going to divide by 1,000. That's pretty easy to do. It's just 75. So she wants 75 units. And then we take the number of units times the cost per unit. So 75 times 2.77. Grab my calculator and I do that. 75 times 2.77, and I end up with $207.75. So each year, her premium is $207.75. That's her annual premium. And all I did there, figure out how many units she's wanting to purchase, take that number of units times the number from the chart, which they told us in this problem, and that gives us her annual premium. At age 55, Keith Thomas purchases an $85,000 5-year term life insurance policy. The premium per $1,000 is $11.45. Again, this is the number that comes from the chart. So they've already done that part for us. What is the annual premium? So we're going to take 85,000, divide by 1,000. I'm sure most of you don't have to write this down each time. So Keith is buying 85 units, and we just take 85 units times $11.45, and that's going to tell us how much it cost him per year. So what his annual premium is. 85 times 11.45, and we get $973.25. That's how much it is per year. Again, remember, so if he pays that in one lump sum, if he makes one payment, then that's what it's going to cost him. But if he splits his payments up, either semi-annually, monthly, weekly, whatever he splits it up to, the insurance company is going to charge him a little extra, a percentage of that, to do the paperwork and stuff. So they're going to make that little bit of extra money off of him if he doesn't pay it all in one lump sum. This one's a little different. Mary Jane purchased a $100,000 whole life insurance policy when she was 45, so this time it's a whole life and not just a term policy. The annual premium per 1,000 is $18.75. Again, they got that off of the chart, and this is chart 11.3 that they're using here. Back. So we're using chart 11.3 on this one, but they've already used it for you. They told you that number, it came off the chart. Every 3 months she puts 1/4 of the total amount in a savings account, so she's doing the smart thing and saving it up so that she can pay it all at once, so she don't have to pay them that extra percentage. How much does she need to save each quarter? So the first thing we need to do is figure out how many. Same idea, how many units she's getting, divide that by 1,000. You end up, she's buying 100 units. We're going to take that 100 units times the $18.75. So if I grab my calculator and I do that, 100, you probably don't even need your calculator, times 18.75. If you know that when you multiply by 100, you're just moving the decimal over 2 places. So her annual premium is $1,875. Well, she wants to know how much she needs to save every 3 months. So we just take that number and not divide by 3. We divide by 4 because we're doing it 4 times a year. So we take $18.75 divided by 4, and that's $468.75. So each quarter she needs to put back $468.75 to make sure she has enough when it comes time to pay her premium. A 20-year-old female obtains a limited payment policy until age 65 of $50,000. The annual premium for this policy is per $1,000 is $975. What is her annual premium? So same idea. They've already told you the number. This number came from the chart that you're going to have to use. We take the $50,000 divided by 1,000. That's 50 units. We're going to times that by 9.75. So I grab my calculator and I do 50 times 9.75, and I end up with $487.50. Don't forget to put that 0 on there because it's money. So that's her annual premium. That's how much her premium is per year. All right, the assignment is these 2 pages. Page 426, 5 through 13, the odd numbers. Page 429, 5 through 11, all of those. Hopefully that gives you a little idea. Again, I'm not any life insurance or medical insurance expert, but hopefully that gives you a little idea so that as you go out and you have to start getting some of this stuff, that you're not just going out blind.